Greetings and welcome to the Wealth for Real YouTube channel. I'm your host, Christopher Anastasio. It is Monday, September 25th, 2023, and I wanted to make you guys a video drilling down a little bit, talking specifically about a paper that I posted about, I think early in the summertime or so. It was at least a few months ago by Raghuram Rajan. It's this paper right here, a paper that he published back in, I believe it was November of 2005, Has Financial Development Made the World Riskier? And, basically, guys, I posted my excitement about that paper at the time on a very generic level. I had watched the documentary. By now, if you've been following me, following the channel, I've raved about the movie Inside Job, the documentary that came out in 2010, narrated by Matt Damon, about the financial crisis, the housing market crash, et cetera, in 2008. And one of the people interviewed in that movie was Raghuram Rajan, and they mentioned this paper. And so after the movie, after I watched it, the dust settled, whatever, I got to the point where I was like, I got to read this paper. I want to kind of dig into this thing. And it didn't disappoint. It was about 40 plus pages or so, I think. Very illuminating, very edifying. Honestly, I could make scores of videos about every paragraph practically in that paper, a lot of them that are beyond my full understanding, just things I would sort of muse about out loud and want to share with you guys. But what I wanted to do, instead of waiting for the timing to be right to go through the paper sequentially, paragraph by paragraph, and make all these videos about it, hopefully eventually we'll get to other videos about it in rough chronological order. I wanted to kind of jump to one just because of some of the activity that I've had going on in my own trading situation, options, that sort of thing, that I wanted to jump to and talk to you guys about here. And so, of course, here's, front page of the paper. If you guys are looking for it, you can Google this, or you can probably find it posted somewhere on one of my accounts. But this will bring it up. You definitely will be able to find it like this. If you go to the Facebook page, it's probably, let me just do a search here real quick and see if, see how quickly it comes up. All right, here we go, July 12th. So if you just search the Facebook page for Rajan, you'll see it there. So just want to make sure I actually wasn't fibbing when I said that you can get it off my page. Also, guys, not really sure why my face, I think, has disappeared here in the lower corner and why there's just a big C there. So if that's what you guys are seeing, my apologies for that, but hopefully you can still see my screen as I share the more important part of this, not my face, but the paper with you guys. So let me switch over to the paper and go to the section that I just wanted to show you guys fairly briefly here. And I think this is something I want to talk more about in the future and expand on, but I really wanted to get a video out to you guys about this section right here, talking about hidden tail risk. This goes right in line with some of the things I've been talking about lately that I'm picking up again from Taleb, who's on episode 691 of the Tim Ferriss Show, with Scott Patterson from the Wall Street Journal. That kind of reignited some of my interest in this stuff. I'd already been invested in put options against SPY or SPY puts. And so I had some of that kind of going already, and I listened to Taleb on the podcast, and I was like, let me, on Tim Ferriss's podcast, and I was like, let me jump to this section in the Rajan paper because it's so timely. And so you can see in just this section here, where he's talking about hidden tail risk, let me just quote a portion of this for you guys from Rajan. Consider the incentive to take on risk that is not in the benchmark, not observable to investors. A number of insurance companies and pension funds have entered credit derivatives market to sell guarantees against a company defaulting. They collect premia in ordinary times for people buying the guarantees. Very small probability the company will default, forcing the guarantor to pay out a large amount. The investment managers are thus selling disaster insurance or taking on tail risks. I've never, by the way, guys, never heard of the term peso risk. Taking on tail risks, which produce a positive return most of the time as compensation for a rare, very negative return. Strategies have the appearance of producing very high alphas, so managers have an incentive to load up on them. Every once in a while, however, they will blow up. Since true performance can only be estimated over a long time, far exceeding the horizon set by the average manager's incentives, managers will take these risks if they can. Now, you notice at footnote 16, peso risk is named after strategy of investing in Mexican pesos while shorting U.S. dollar. produces a steady return amounting to the interest differential between the two countries, shadowed by constant catastrophic risk of a devaluation. Another example of a strategy producing such a pattern of returns is to short, deep, out-of-the-money S&P 500 put options. And so I will come back to why that was ironic here in a moment. But anyway, that's the explanation of this section, this little section right here, the sentence, footnote 16. So why am I showing you guys this? There's three reasons why. The first reason is because this was written in November 2005, or published in November 2005, well ahead, but not too far ahead of AIG probably being the most notable blowup, like Rajan talks about here. Companies selling disaster insurance, assuming there's never going to be a disaster, and not providing for the ability to pay out when the payout occurs, when the disaster occurs, and you actually have to pay on these policies that people have been taking out with you. So AIG blew up on that basis. They cratered. We had to save them. Whatever. I think we saved them on some level or another at the time. We all paid that bill. But here you have Raghuram Rajan highlighting this issue very clearly here. To be honest with you guys, this is one of the more understandable paragraphs in this paper for me, because this jumped right out at me because of the tail risk issue and everything I've followed with Taleb and stuff like that. This made perfect sense to me, harkened back to AIG. And here, I think you legitimately have somebody calling this disaster, this AIG meltdown, 3 years ahead of time. Published it in November of 2005, and AIG collapsed in the fall of 2008. So pretty solid timing there. And so I think just in general, what does that mean? It means pay attention to this guy, pay attention to Rajan, read this paper, look at some of the things that he's talking about here, and make your own conclusions from there. But really notable that he pegged this thing the way that he did. The second thing that I wanted to bring this up to you guys is because, it's one thing to look back at this and be like, oh, Rajan talked about this in 2005, AIG blew up in 2008, he's a genius. It's like, let's look at it a bit fractally. What thing like this thing is happening right now in the U.S. financial system or the global financial system, right? Like some actors somewhere are doing bad things like this, okay? And the thing is, we all hear the top line news, the jobs report was good, the dollar's strong, the U.S. is on track to, lower unemployment. You get all these surface level headlines that soothe you into feeling like, and I'm not even saying everybody goes for this, but can soothe you into feeling like, okay, things maybe aren't that bad, or we're going to avoid a recession. You have the Federal Reserve lowering recession target percentage rates. There's only a 10% chance now instead of 20%. Just these meaningless, utterly meaningless statistics and metrics and benchmarks. And meanwhile, we don't know, not being on the inside, what thing like this thing is happening right now in the system, right? This thing was happening in the system, building up and building up and building up through the 2000s. I think probably safely speaking, when the Commodities Futures Modernization Act of 2000 and the Glass-Steagall repeal in 99, when all that had happened right at the turn of the century, we just know in general that financial institutions were able to take on outsized amounts of risk, way more than they ever dreamed of, to goose profits, increase CEO pay packages, whatever the case may be. But at that turn of the century, they were able to start doing really crazy stuff like this, generally speaking. And so in that first decade, that's where the groundwork, the dynamite, was being stacked on top of each other to eventually blow towards the end of that decade. So something like this, or things like this, maybe some of them are even visible if we're paying really close attention. And I suspect some are completely invisible unless you're on the inside. But this stuff is happening, and the question is, when is it going to blow? What is it, and when is it going to blow? And how bad is it going to be when it does? So that was the second thing I wanted to kind of point out to you guys. We can go on about that all day. The last reason is just more of a personal thing, and it kind of goes to this point right here about shorting deep out of the money S&P 500 put options. I went the other way with that, guys. I've been posting lately about my SPY put options, 355 strike price from, I think I bought them when S&P was around 450. So looking for a big, steep decline, almost 25% on the S&P. Actually, the option is up since I bought it, but the portfolio is negative because When the option does well, it means my stocks aren't doing well. But the point is, guys, that it's so interesting to see somebody say this, that most people go on the other side of this trade. They short these types of options thinking, hey, no such thing is ever going to happen. Well, then along comes a guy like Nassim Taleb who buys these kinds of options, or the fund Universa that's run by his associate Mark Spitznagel. They actually buy these options. They don't short them. And that one time when everything blows, like in late 2008, these guys make, a gazillion%. So I'm on the other side of this trade, guys. I just kind of wanted to point that out. That's obviously what I've been posting about lately when I talk about my option stuff and what I'm doing with options, and I'm keeping it real narrow, using the Universa trade, the Spitznagel trade. And so I thought it was really funny that the opposite side of that trade is actually highlighted in this paper. And this citation here, 2005 in the paper, 2005, predate the Black Swan by Taleb by 2 years, which came out in 07. But of course, in that book, The Black Swan, Taleb mentions buying out of the money put options for a steep decline in the S&P. So just interesting how, both sides of that coin are reflected there. So anyway, guys, I really think that that paper is worth reading. Would love to hear what you guys think about it. Would love to hear your reaction to it. Like I said, I would really like to go from start to finish through that paper at each notable section, maybe not every single paragraph, but each notable section that jumped out at me, and make you a video about it. I skipped ahead to, the midpoint of this paper, almost literally the midpoint of this paper, to show you guys this thing about tail risk, because I think it's so compelling, and I think it's so relevant to what's kind of going on right now, and and what could be going on soon, as well as what's going on with my own personal trading. So until next time, guys, thank you so much for watching this. Thank you so much for consuming the content, checking in on this stuff, contributing, comments, questions. Everybody who's commented and sent questions on stuff that I'm posting, I can't thank you enough. It means the world to me. But yeah, would love to hear what you guys think about the Rajan paper, the tail risk issue, the options, anything like that. Hope everybody has a great Monday night, and I'll talk to you guys soon.